Hello, everyone. It is good to see you. You're probably wondering, like, where did that music come from? You can thank the amazing technicians and folks at StreamYard for putting that background music on here. I think it's actually a pretty decent idea because I sometimes don't know how long it's going to take to go live. So we'll fade that out. And I appreciate you guys showing up today. This is the Strategic Boardroom Show. It is really good to see you. Man, I am very bleached out on this. Let me adjust my lighting here. All right. It's good to see you. Thank you for joining me. And here we are tonight live. I've got a couple of things to show you today concerning business loans, or for those of you who might be interested in getting a business loan. It's really interesting because I got, as much as I am educated and have been I was an underwriter for a number of years, and I'm pretty well on top of my game. I know what I'm talking about when it comes to getting a business loan, getting banking loans. I work with a lot of people with their businesses and through their businesses so they can get funding, so they can expand their operations, so they can free up cash flow and get a little breathing room from time to time. And it's not straightforward. I'm just telling you that right now. People don't understand what all goes into it. I'm not going to show you how to be an underwriter overnight. It actually takes a long time to do that, but I am going to show you just a couple things and demonstrate some just different things that you can see that aren't really all that straightforward. You might be thinking, well, how in the world can I get a loan for my business? Or how can I possibly grow my business if I'm not able to get a loan for it, if I can't get financing? And I get it. I totally understand it. So what I'm going to do is I'm going to show you just a couple of things today, specifically as it relates to debt service coverage and getting a business loan. Now, a couple of things I want to talk to you about first and foremost is getting a business loan right out of the gate is not as straightforward as you might think. And if you don't have any revenues, you getting a business loan from a bank is pretty much out of the question. Unless you've got really rock solid credit, unless you're able to come to the bank with some, not just collateral, but some physical assets that are actually generating income for you that they're going to then collateralize, you're not going to get a loan. I'm just letting you know that right now. So today we're talking about getting a bank loan, getting funding for your business, getting funding for your startup, or getting funding for your ongoing endeavor. That's one of the most common questions I get as a strategist. And it was interesting today, just tonight, I met with my banker, had a wonderful conversation. And there's certain things that he was saying, hey, this is something we can work with, and this is something we can't work with. Okay, cool. And some of it might be related to credit score. Well, wait a minute. I thought this was a business loan. Why is it related to my personal credit score? I'm just telling you it matters. And it matters to certain lenders more than it matters to others. So this is really important when you start thinking about the context of getting a bank loan, getting a business loan. This is probably, honestly, this is mislabeled. I'm going to say getting a business loan, because getting a business loan is not necessarily the same thing as getting a bank loan, right? So just let me just make that distinction there. So getting a business loan. So getting a loan for your business. Now, I'm not here to rain on your parade. All right. So for those of you who are thinking, well, I want to be able to get a loan for my startup, I've got this amazing idea. That's great. But the chances of you getting funding from a bank for something like that are pretty low. And the reason why is because banks are in the job of managing risk. That's what they're in the job of doing. So they manage risk by not lending money to people who aren't already making money. So if you don't have a cash flow coming in from this business idea of yours, chances of you getting funding from a bank are, like I said, pretty low, which again, doesn't mean you can't get a loan from a business loan, but you probably getting it from a bank is pretty low. So that means you're going to have to look at bringing something to the table that they would say yes to. Okay. So this is where it starts to get into the conversation around debt service coverage. And that's why I've got the thing showing up here And if I bring this up on the screen here, if I'm looking at debt service coverage ratio, you can't see that. I'm going to make that way, 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 way bigger. Give me a minute. All right. I wish that StreamYard had a whiteboard function. I would love this. So debt service coverage ratio. Who of you out there knows what debt service coverage ratio is, right? And knows how to calculate it? Well, if you say yes, then I applaud you. But you've got to be careful because different banks record or they calculate it a little differently depending on the entity. So I'm not going to get super in the weeds tonight on how to calculate this, but this is really, really critical on how to calculate debt service coverage ratio and how to do it the right way and how to do it in a way that a bank is going to want to pay attention to you and most likely give you money for your endeavor. So before I get super in the weeds on this, I just want to share with you guys, if you see the QR code, man, this is really hard to do mirrored. You see that QR code right there? That's my school community. If you are interested, you can join me on school. Talk about stuff just like this. I just got started in school. I actually just really think it's a really cool platform. And we talk about stuff just like this all the time. Business related, entrepreneurial stuff. This is the sort of stuff that really kind of winds my clock. So in terms of debt service coverage ratio, you got to understand there's the debt service coverage ratio that they calculate is going to be a little different depending on what's called subject collateral. So when I say subject collateral, I'm talking about the collateral that they are going to attach to that is basically going to be, they're going to put a lien on that, right? Now this is just what they do. So they're going to put a lien on your assets, like a mortgage or, basically that's the way they do it. So if they're going to attach to that subject collateral, that collateral has to be able to by itself service the debt. Okay. So I'm just saying if they're going to attach to the assets of a business or the accounts receivable of a business, then that business has to be able to cash flow the loan. Okay. If it's going to attach to real estate, then that real estate has to cash flow the loan. So what I mean by debt service coverage ratio is, let's say for argument's sake that the net income, okay, so we're going to say net income here is, let me make that a little bit smaller because you guys can see that. Sorry, I'm going to find a different way to do this because Word is good, but Word is not necessarily my best friend when it comes to this. So again, let's say that your net income is, you guys can see that. Okay, so let's say it's 200,000. Okay, now I'm just going to keep this super, super simple just for right now. Again, if we want to get in the weeds in this, this is stuff that we can get into in the school community. But just for right now, let's just say that the net income is $200,000. Okay, now let's say that for argument's sake that you don't have any debt that is being serviced by the company. So the revenues might be 5 million, but you make 200,000. That's what you get to keep. All right. So the $200,000 is what's going to service the debt. That's important. That's really critical. Now, if you had interest or if you had depreciation expenses, you would add those things back. So in other words, if you had $2 million in expenses or $2 million in revenues, and we can just go do this real quick. So let's say for revenues, right? Those are your sales. That's what the business is making. Let's say you did have $2 million and this works across currency, by the way, because this is pretty standard. So if you have $2 million in revenues and you have $1.8 million in expenses, then your net income would be 200,000. But let's say a part of those expenses that you have are non-cash expenses. So one of those non-cash expenses would be interest. Okay, so let's say that for argument's sake, you have 100,000 in interest, and you say, well, how is that non-cash? It's non-cash from the perspective of the fact that it's going to get added back into something that when you're referring to like an EBITDA conversation. We'll talk about that here in a minute. But so you're going to add back interest and you're also going to add back depreciation. Okay. So this is important. So let's say depreciation is another, let's say depreciation is another 100,000. Okay, just for the sake of say to make it nice and easy. So the net income is 200,000 after you subtracted out $1.6 million in other expenses, 100,000 in interest, and 100,000 in depreciation, which equals 1.8 million, which leaves you $200,000 in net income. It's pretty straightforward, right? When you're going to be calculating a debt service coverage ratio, what you're going to do is you're going to add back. So I'm going to put a little plus sign, right? You're going to add back $100,000 to the equation here. All right. And that's going to be important. And why am I adding back $100,000 in interest? Well, because if you're going to be borrowing against a new loan, it doesn't make sense to leave that existing interest in there, right? So you're going to say, no, we're going to have our own interest. We're going to be paying you interest now. So they're going to add that back to a debt service coverage calculation. So they're going to add back interest. They're also going to add back depreciation. So they're going to add back another $100,000 in depreciation. And depreciation is if you don't understand depreciation is the writing down of the value of an asset over time. So in other words, if you buy a $500,000 printer, right, and the useful life of that printer is 5 years, you're going to depreciate it by $100,000 every year, right? Makes sense. So that comes off that's expensed every year, and that comes off. So that's a non-cash deduction, right? So you're going to add back 200. You're going to add back 100 and 100, which now you're going to have $400,000 for cash, for basically cash flow available for debt service, right? So this is going to be cash flow available for debt service. Okay. So now that 400,000 that you have available for debt service, that's what you're going to be amounting to. That's what you're going to be accounting for in your loan calculations. So let me pull over and park here for just a second, because again, this is all going to matter if your subject collateral is, let's say that you own a manufacturing company and you manufacture, let's say that you put together earrings. Okay. And that's your manufacturing. Okay. That's fine. Or you put together heavy steel equipment for, some auto company, right? Whatever it is. So the point is that you have to consider what the subject collateral is going to be. If your subject collateral has been fully depreciated, because that's what they're showing, right? There may not be much inherent value for them to loan against. There may not be much of a loan to value. So they're going to be paying attention to really fully on your ability to service debt. So this is really important. If you've got subject collateral, which is real estate, which does have inherent value and generally gets more valuable the longer you hold it, this is important. So you got to recognize that calculating debt service for business versus calculating debt service for real estate, it is different. So I know many of you might be thinking, well, what if I've got both? That's fine. But just understand that if you're going to offer up collateral, that collateral has to be able to carry the debt service by itself. Okay. And this is really important because if you think like, well, what if I own a warehouse and that's where I operate my business out of? Okay. So I operate my business out of this warehouse. The warehouse is worth $2 million and the business makes, say, $300,000 a year. Okay. Well, that might be great, but at the end of the day, who's the original payer? Who pays the bill on that? It's the company, right? The existence of the company. The warehouse doesn't pay. That's not like you rent that to a third party. That's not you. What you're doing is you're renting it. You're occupying that business, and that business is what generates $300,000 a year. If that business dries up or goes away, that warehouse, you're going to have to find someone else to rent it. And would that building therefore rent for $300,000 a year? It might rent for more, it might rent for less. But the point is, you have to, if you're offering up subject collateral, you have to consider how much that collateral can generate in cash flow. It's the name of the game. Right now, some lenders will loan based on the value of the collateral and that alone. There's not a lot of those, but there are some that will do that. So you might say, hey, this building is legit worth 200,000. So let's say that the building is legit worth $2 million. It's got all this equipment inside. It's got high tech, blah, 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 right? All this, it's wired. It's got offices. It's really nice. Okay, great. Let's say it's legit worth $2 million. That's fine. Here's the issue. If the building is worth $2 million and you want to get a 70% loan to value loan, okay, that's great. It's $1.4 million. Is your company that makes $300,000 a year going to be able to service $1.4 million in debt? That's the main crux of the issue. So do you see how the collateral property, the subject collateral property, really ties in to how that property makes money and how that property generates money? So that's the consideration here. So with this, we go back to our example here with this $400,000 of cash flow that's available for debt service. So again, I'm just going to use numbers that are kind of round. Okay. So again, just to go back over this, we're talking about debt service coverage ratio. So we got $2 million in revenues. We talked about adding back the interest and depreciation to your net income of 200,000. So again, we add back 100 and 100. Now we have $400,000 in cash flow available for debt service. Awesome. So now this is how we're going to calculate our debt service. We're basically going to figure out, now let's say for argument's sake that these are annual numbers. So it's 2 million in revenues for the course of 1 year, and interest depreciation, and you have net income for the year of 200,000. Excellent. So now you're adding all this back. Now you've got $400,000 available for debt service coverage over an annual period. So what you want to do is you want to make sure that when you're calculating your debt, your proposed debt, that you're calculating that based on an annual repayment. Now, most banks are going to want to, at least on a monthly basis. So let's say, or most lenders in general, not just banks, but lenders. So let's say for argument's sake that the payment was $10,000 a month. So that's going to be debt service of $120,000 per year. So your debt service is $120,000. So there's no way I'm doing that math in my head. But if you're going to say, for argument's sake, that you've got, oh, my calculator's not popping up. But let's say for argument's sake, what you're going to do. So the math is going to be 400,000 divided by 120, right? So you got 400,000. Just demonstrate the math up here. So from here, as you're calculating debt service coverage, you got 400,000, right, divided by $120,000 in annual debt service. Okay, so that yields a debt service coverage ratio of 3.33. Now you might be thinking, for those of you who don't know, is that good? Is that bad? Is that terrible? That's really pretty solid, actually. So when you're looking at a debt service coverage ratio of 3.33, usually anything above a 1.5 for a bank is pretty much a home run. If you're looking at a debt service coverage of 3.33 or better, based on, again, subject collateral and and it truly being able to cash flow at that level, anything above a 1.5 is pretty much a home run. They're usually looking for loans, or debt service coverage ratio that'll be either a 1.2 or 1.25. So for it to be over a 3 is really, really good. I mean, it's kind of a no-brainer. Now, there's other reasons that they're going to look for, and then they'll find other reasons to say no if they don't want to do the loan. But I'm just saying, like, this is where you have to stop and think about it, is that when you're doing a, generally what you're going to see is, like, let's say you got this $400,000 loan, right? And let's say you're looking to, and let's say it's a $300,000 debt service, right? Based on annual debt service. So that's 400 divided by 300. I'm not doing that in my head. That's 1.33. That's probably something that you're going to see more of, something along those lines. That's pretty typical. So you might be thinking, okay, well, why would it, that seems pretty lean. That only leaves you like $100,000 in actual cash flow, right? To to live on. Yeah, to me that's lean. I wouldn't even recommend doing a loan unless it was 1.5 or better, just because the deal doesn't sound that good, and especially when you're looking at it from a real estate perspective. But this is how you start to figure out your debt service coverage ratio. Now, to add a little bit to this, because you guys are a smart bunch of folks, what we're going to look at here is global debt service coverage. Now, again, this is starting to pull into the realm of what I see with many different entrepreneurs and small business owners, is that you look at it from a global perspective. So what does global mean? So this is a really good example. And we were talking about this today. I was talking about this today with my banker. And I have a property management company that makes money. I also draw a salary from that property management company. Okay, so I get two sources of income from that management company. I also have my rental portfolio that makes money. I also have a consulting company that makes money, Strategic Boardroom. Okay, so I have really 4 different sources of revenue, but if I'm being really straightforward, it's 3, because I have one from the management company, and even though I get 2 sources of revenue from that management company, it's still one management company. So that management company went away. Both my W-2 and my income from that company would go away. So I make income that way. But realistically, it's 3 sources, but I counted, there was 4 in there that were separate. Okay, fine. So if I'm looking at this from a global perspective, what I would do is I would add in all those sources of income that would come into play in terms of being able to repay the loan. Now, I will tell you this, from a global debt service coverage ratio, it's not as complex as you might think, but really what it's doing is it's taking all of the elements of what I calculated up here and just adding all of those in to the equation. So in other words, what I'm doing, and let's say I owned 4 different businesses, I would take the debt service coverage ratio calculation that I did here and do that for all 4 of the businesses. And basically I would take that 400,000 of cash flow that's available for debt service from company A. Then I would take the 250,000 in debt service from company B. And then I might take the 100,000 of cash flow from my rental portfolio and add that all up. And that's the global calculation that I would use that would cover debt service. So that, to me, is it does matter. And there are some lenders who will look at things that way. However, you got to keep in mind that if they're still going to try to collateralize properties, if they're still going to try to attach to properties, some lenders may not look at a global perspective. They might look at the global perspective and go, okay, yeah, it's an indication that you're healthy. But a lot of times they're going to look at it from the other aspect to say, look, you've got this business from this perspective really does well, and you're making a lot of money in this. And yes, the subject collateral has debt service coverage of 1.5 or 1.6. That's great. And the loan to value is below 60%. That's great, right? But you've got these 4 other businesses here that are losing $100,000 a year. That's where global debt service calculation maybe comes in, is that they're going to look at it globally and say, look, this portfolio is great, but globally you're a mess. Okay, so they don't generally look at global as something to make you look better. They're going to look at global to almost try to find a reason to disqualify you. So let's use this as an example. So again, let's say from a global debt service coverage ratio, we added back in now. So from here, so I'm just going to go straight to cash available for debt service. And we're going to say this is company. We'll just say this is company A, right? So cash available for debt service, we're going to say that that's 400,000, right? And then company B, cash available for debt service. which is say 300,000, and then we'll just do this the fast way, not the silly way. So from there, we have company C, that cash available for debt service, we'll say that's 100,000. Okay. So now the total cash available for debt service from a global perspective is 800,000. Okay. So that's great. So now if you've got 800,000 that's available for debt service, now you could say, okay, cool. If I'm going to borrow money, let's say I'm going to borrow $300,000 or $400,000, or I'm sorry, where the annual debt service is $300,000 or $400,000, global debt service is going to look really good, right? It's going to be like 2-to-1 or better, right? So again, to do that math. So when you're calculating the 800,000, so it'd be 800,000 divided, say, by 400,000 in annual debt service. That obviously is a debt service coverage ratio of 2-to-1. So that's really high. Like I said, if you're looking at debt service coverage ratio, anything above a 1.5 is generally a home run for a bank. So that's where you're starting to think, okay, well, but how would this matter? Why would they not look at global debt service coverage if you're the entity and you're willing to provide a guarantee, and you're willing, and all these additional companies that you own are willing to be the guarantor for this loan? Why wouldn't they do that? To be honest with you, I'm not 100% sure. I mean, I think it makes good sense, but here's where I could play devil's advocate for the bank. Not that the devil ever needs an advocate, but here's what I'm saying. Let's say, for argument's sake, that what you're trying to do is borrow money to benefit company A, and company B stands on its own, company C stands on its own. But here's the problem. Let's say if company B goes out of business, right? Companies fail all the time. And company C, let's say it doesn't go out of business. So let's say that this goes to zero, right? And this one starts actually making a loss, right? So now it goes to 500,000, but it's a loss. Okay. So let's see here. Right. All right. So now we've got that. So we got this for cash available for debt service. So now you're actually at $100,000 loss globally, right? This is a problem. And this is the reason why banks will look at a global cash flow perspective to see if you are potentially weak as a borrower. They're going to look at this. They're going to look exactly at this. So it's almost like they look at global to find a reason not to qualify you rather than to qualify you, because the subject collateral has to carry its own. It has to carry it by itself. So this is something I just want you to think about. I know this isn't super easy to think about. Like, okay, well, why wouldn't I want, why wouldn't I want a bank to look at my global debt service coverage ratio? Well, you would. It just depends if they will. So like I said earlier, this is going to be a big difference if you're going to be looking at a bank that's going to be, if you're borrowing money from your company that's a manufacturing entity versus a company that maybe is more real estate based. So that's a difference. So one thing I do want to bring up real quick, like I mentioned earlier, is this calculation of EBITDA. So the calculation of EBITDA, you might be thinking, well, what in the world is EBITDA, and how do I make sure that I don't ever get EBITDA, or is there a vitamin that I can take to avoid EBITDA? No, EBITDA is not a condition. It's not a social disease. It's not anything like that. But what it is, it stands for earnings before interest, taxes. I should put in commas here. Earnings before interest, comma, taxes, comma, depreciation, comma, and amortization. All right, so we're going to cover these things really fast because I'm really not trying to make you guys into super high-speed, low-drag accountants. I just want you to understand what these phrases are when you see them and why they might matter to you. So EBITDA, what that is, we kind of calculated EBITDA, even though we didn't necessarily call it EBITDA. But what EBITDA does is it's going to take net income, right? So you're going to take net income and you're going to add back earnings, right? So net income is earnings before interest, taxes, depreciation, and amortization. So what do I mean by that? So this is earnings before interest. So we're going to add back interest. Why does that matter? Because interest is a non-cash deduction. And I know you might be thinking, well, yeah, you pay cash when you're paying interest. Yes, but when you're calculating it, especially from a debt, like if you're calculating new debt service for a proposed loan, you're going to want to add that back because then it would be double dipping, right? You're taking out interest from the existing loan and you'd be taking out the interest from the proposed loan. So from a lending perspective, it's absolutely critical that you add that back. From a cash flow perspective, the thing where it comes back in is when you're actually calculating debt service. So EBITDA is almost always a measure that's going to be used for calculating debt service. So I'm just letting you know you're going to add back interest. You will also add back taxes with the exception of property taxes. So if you're paying property taxes or local taxes or business taxes or anything like that, those are not what I'm talking about. Those are general, those would be considered like operational expenses. But if you're adding back income taxes, that absolutely matters, right? So you're going to add back taxes. You're also going to add back depreciation and amortization. Now, depreciation and amortization they're kind of like sisters, more cousins, I guess. Depreciation is the marking down of a physical asset. Amortization is the marking down of a non-physical asset, like a non-tangible asset. So what you might be thinking is, like, so for some of you might be familiar with depreciation of a physical item, right? So you've got this pen, right? And let's say this is a golden pen that's going to be, well, golden pen. Gold wouldn't depreciate, but let's pretend it's a pen that's worth $10,000, right? It's a really good pen. And it's got a useful life of 5 years. So I would, for straight line depreciation, I would mark down this pen $2,000 a year, right? Until the end of 5 years. So that's how you do depreciation. So this depreciation, it has a useful life, right? And that would depreciate down over that period of time. So every year that depreciates, you would add back that depreciation from your income statement. In terms of amortization, that is a non-physical asset. So the non-physical asset in this particular case might be something related to like a loan, right? Have you ever heard of loan amortization? Well, that's why they use the word amortization, because it's actually the marking down of a non-physical asset, or basically an intangible asset, right? So a financial asset or a bond or something along those lines. It could be intellectual property that gets marked down over time. Those are sorts of things that get amortized over time. So this is how you come up with an EBITDA calculation, and that's exactly what we used up here with cash available for debt service. That's actually also EBITDA. So I just want you to understand, if you hear that, like, don't freak out, don't get catatonic on me. It's not all that scary or all that crazy. So where are you going to go for loans like this? So I know we talked about getting a business loan. You might be thinking, well, what does this have to do with the price of tea? Well, it's going to depend on the different types of lenders that you go to. But I will tell you that if you have a startup with no revenues, I'm just going to help you save some time. Unless you have a crap load of other assets that are currently generating income that you can provide for collateral, that you can draw money out of, that's got a lot of equity in it, I'm just going to help you. You're just going to save you some time. Entrepreneurs often struggle with this. Like, they've got a business idea. I teach a free course called Business Plans 101, and a lot of entrepreneurs come to that one. A lot of people with lots of ideas, and entrepreneurs aren't the only ones who should be doing business plans. I mean, it really should. I could make the argument that a business plan should be for even solopreneurs, people who already have businesses established that maybe need a strategic direction, maybe want to do something different, maybe want to go into a different market. Maybe they want to open a whole new product or service line. Those are all reasons to do a business plan. Lots of different reasons. So all that aside, the people who come to me for the Business Plan 101 session is they really want to figure out how to get this business plan put together so they can put this in front of a group of investors, which makes sense. I get that. I understand why you'd want to do that. But this is the problem, that most banks are not going to touch something like this. So you're going to be looking for like an angel investor. You're going to be looking for someone who's going to want to come in. Yes, they will loan you money, but they're going to probably take a substantial portion of ownership. They will probably control a lot of the decisions, because a lot of entrepreneurs really don't have business savvy. They have an idea. And if that idea has any sort of potential, this angel investor is going to know, not only are they going to have the money, but they're going to have the contacts to help grow this idea into something special. And that's what's really important to remember, is it's not just the money that you need, even though you think it might just be the money that you need. It's also all of the business expertise that comes with it. Like, how do you know to do lead generation? How will you know to find customers for this? You're like, well, the product is so good, everybody's going to want it, says every entrepreneur. Okay, fine. Maybe it is, but you're still going to need to do marketing. You're still going to need to do some sort of outreach. You're still going to need to do some sort of promotion. Do you even know how to open up these channels? Do you even know where to start? And do you know where to start in a way that's not going to cost a fortune of their money? Right? So yes, angel investors aren't necessarily bad, especially when they come to the table with a lot of other groups of people around them. They've done it enough to know, like, you need to talk to Joe over here, and he's going to help you get you started out in your marketing, right? You're going to need to talk to blah, blah, blah over here, to help you out with your sales team, because your sales team just isn't cutting it. And your sales team of you just isn't cutting it. So, the idea is great, and trying to spread it word of mouth is great, but word of mouth marketing is amazing. But the problem with it is it's not scalable. So I love it. Don't get me wrong. I'm an avid networking guy, but at the end of the day, networking is great, but it's not scalable. You can't rely on it to scale. So this is why I'm saying it's, these are the sorts of people that you're going to be looking out for, who do provide that sort of capital. Now, have I done that sort of capital for people in the past? Yeah, a little bit, but mostly what I do is provide the expertise, because I feel like if I'm providing the capital and the expertise, now I'm married to that individual, and that individual only, and that business only. And I'm not willing to do that right now. I think for me, it creates a conflict of interest, where even though they might be the CEO of the company, if I'm not 100% in charge, that could be a real problem and could put my money at risk if they don't do what I recommend them to do. So I feel like that I really like staying in the consulting realm, really like staying in that coaching and consulting realm and teaching realm, so I can help people make the best decisions, and then they get to keep all the profits, right? I think it establishes a different standard. So that's everything there. So for those of you who might be thinking, man, I went to the bank and the bank told me no. Okay, fine. Just understand that if you're subject collateral, banks, look, sometimes they will wax and wane. And sometimes the relationship between you and that one bank is going to be hot and heavy. And sometimes it's not, right? It's just like any other lending relationship. And you don't know what that bank is going through at that moment in time. You don't know if they're going through an MOU or a cease and desist on certain things. You don't know. Right? You really don't know. So, if they have to tighten up on some certain lending standards that they used to do in the past for you, you're like, I don't understand. You said yes to this all the time, and now you're telling me no. I'm just telling you, the bank is great until it's not. So when you go, you might need to bring that loan proposal to a number of banks and just ask them, say, hey, look, I'm not asking for a decision right now, but can I walk you through this? And at least on its premise, does this look okay? And before they send it to the underwriter, and they're like, yeah, most of them will say, sure. And then the underwriter asks you for 900 different things beyond the scope of this session right here to tell you all the things that you should have. But I'm just telling you, like, this is the sort of stuff that you have to keep in mind. But you also have to recognize the limitations of what a bank's going to say yes to. So if you're bringing to them a real estate portfolio that you maybe want to refinance, understand that that real estate portfolio has to stand on its own. It has to stand on its own. Right? That subject collateral decision that we talked about. All right. So I don't want to get repetitive here, but I think I'm going to put the fries in the bag. So thanks for sticking around. If you guys are interested, again, like up here, did I get it right? Yes, up here. I'm not used to pointing in this direction. If that is the QR code for school, if you'd like to join me, it is, I don't know if there's a way that I can put this in the comments here. Yeah, I think there is. So I'll post this as a comment. And oh, no, that is pasting the wrong thing. Let me do this real quick and I'll post this in the comments. I'll also put it in the show notes so you guys can have that. If you'd like to join me on the school community, it is, we're going to be talking about stuff just like this if you're interested. And there it is. It's posted. So you guys are welcome to join me there. There's a paid portion. There's a free portion. You can do whatever you like. The free portion is stuff just like this. The paid portion is going to get far more granular and specific in terms of what you're going to need. And it's a brand new community for me. I really like the platform. Lots of really good people on there too. So don't just look around for me, but look around for some other folks that may have some other stuff that you may want to learn. I was a little skeptical at first, but I've got to tell you, I'm actually pretty happy with what I see. So thanks so much for sticking around, everyone. Have a great rest of your day. See you guys next time.